what to do next in your property planning portfolio journey. Do you go residential? Do you go commercial? Or do you even look at shares? So many questions in this pod that we break down in Jaryd's property journey. And we discuss things like what's actually going on in the global economy now to actually help you make that decision. And what are the implications if you do nothing as opposed to doing something? And we break down some really key questions that a lot of people are asking in Jaryd's current journey, where they own a few properties and they want to keep expanding, but they're not sure what to expand into.
Yeah, this is a good little selfish episode for me, but great insights from you, Sam, on right, I've got a couple of resis, I've got one commercial. What's my opportunity cost of waiting to get a bigger deposit together before buying a commercial, or do I get into residential now? And then it's not just like resi versus commercial. You also mentioned where are you at in your personal situation in terms of income, how fast you want that income, what sort of things do you have in your life? Do you have kids? Do you have how long you going to be in your job for? All these sorts of questions that can affect not just should you buy resi or should you buy commercial and when in your portfolio, but how that fits in with where you're at in your life. And you also discuss areas, some examples of friends that have, invested. And yeah, such a valuable podcast episode. If you're looking at just buying your second property, what you should be thinking about.
Yeah, a lot of meat potatoes and a really actually insightful conversation that I know a lot of people are going to get a lot of value out of. So jump on in, enjoy it. But as always, this is not the only way we can help you for free. Jump onto our website, propertypals.au/resources to get a cheeky little free download, which is how to increase your borrowing capacity, which, Jaryd, in your instance, is really important now because by increasing that borrowing capacity, it increases your options for potential assets to purchase next in your portfolio. See you on the inside.
Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional.
Yes, let's do it, Sam. Opportunity costs of commercial versus resi.
Yeah, well, we're doing a bit of a live portfolio build here with you, and you keep coming to me with some good questions that we keep wanting to share with the community, right? So
yeah, this is exactly why we started the pod. Me just asking you questions and be like, what do I do with my life? Please help me.
What do I do? I don't know, mate. What do you do with your life? I don't know. Meditate, go surfing. Pretty much everything you're doing. Don't eat what grain-fed meat.
Yeah, be gluten-free like me, and you'll be cool.
Listen to your body.
Yeah. No.
What's the real question?
Yeah, the real question is I've been thinking, do I wait and save a bit more money and buy another commercial, or do I go and buy a resi now and then maybe another resi later? I just want to assess the opportunity costs, because there's conflicting information. And even me, as I learned through the journey, is all right, commercial buyer's agent says this, and then a resi buyer's agent says this, and then you've got how do you work out the middle path that's right for you? And then should I buy it myself, or should I buy with a buyer's agent? Or what does the perfect portfolio look like? And it's not what everybody else is doing and what everybody else suggests. It's based on what's right for you and how aggressive you want to grow, or how non-aggressive you want to grow, and diversification and whatnot. So I kind of want to come to you and be all right, if I've got 100K now, should I just go buy a 400 to 500K property in resi, and then maybe I have 100K next year that I could spend? Do I do that as well? So this is for people that might have a bit of cash that is do I buy a resi now, or do I like save that for a bigger deposit for a commercial? So where do we start?
Well, case by case for everybody, but you start with you as an individual. So I'll give you a quick little rundown as to where I see, resi, commercial, both are good options. You're still investing, getting growth. You're going to get better cash flow with commercial, and historically you get stronger capital growth with residential on that front.
Yeah.
So it comes down to, like, obviously you've gone down the commercial journey. I like a balance of both, and obviously you've gotten to that stage. Like, your portfolio will always get hamstrung with cash flow if you're just purely residential focused and you're not looking at
If you're just going for
adding
capital growth, more so.
Yeah.
Yeah.
And like, you can go and add granny flats, and everyone's got their own opinion. I do like granny flats. However, you're looking at, for a decent granny flat, 150 to 250 grand these days, 2025. So, and you're generally using equity to sort of pay for that. And what does that mean? I just sit there and go, what else could you do with 200 grand? You got to weigh it up. Most times the granny flat is suitable to someone who's past their accumulation phase, and they're sort of going into that consolidation and cash flow phase later on in their journey. So where you're at in that sense is, like, only you can decide. And that the question I have for you is, like, what is your desired time frame to hang up the boots, essentially, and sort of live off the income of your portfolio?
Yesterday, Sam. That's what I.
Yeah, well, you mentioned that, and that's why we went down that commercial route initially, to enhance your borrowing power for future purchases. But
but jokes aside, like, I get it. It's going to take time, and I'm fine. Like, I'm fine with delayed gratification. What I would prefer is, like, to go aggressive on growth more than just, like, let's start to reconsolidate and take some properties down and, like, decrease my debt and get some cash and retire. Like, I just want growth. And what I've, like, we've chatted to so many people about residential, and, like, the opportunity cost of, like, buying commercial versus buying, like, multiple resis for growth. Like, what I've realized is a lot of people like, cash flow is good in commercial. Well, like, depending on where you're starting at and depending on what deposit you put in. So most people say that because, and my belief is because you're putting a larger deposit for it, and your loan to value ratio is smaller than what you would do with resi property, which means you've got more equity tied up in that commercial property, which allows you to have that cash flow. That equity might not be, in my thought process, it might not be actually put to best use being tied up with a low loan to value ratio in a commercial property versus having that equity put into high growth areas, like multiple 3 to 500K properties in, like, regional areas or, warm spots that we talk about. And so, the complexity of and going through the experience of buying a commercial is, like, mine's not really high cash flow positive. And yes, I have a decent deposit. It's not huge. It's not like the 50% like some people are doing that are, like, mega loaded and stuff, but it's not high cash flow. And the growth for it is, I mean, I was lucky in this commercial deal that I bought it for. I bought it for, like, the tenant was underpaying, and I renegotiated a better lease, and so I added value to the property by doing so in the first, like, month or two. But that's not normal, and so with that, like, it still doesn't make it that much more cash flow positive. Plus, like, the growth of it isn't going to be better than a regional area. So if the cash flow is not there, like I'm not like swimming in cash from this thing, unfortunately, from this commercial property, and then I've also got, I can put other money into high growth areas. Why would I, like, maybe I can be proved wrong.
Well, the ultimate thing is investing, and you never know. Like, you can go in with an understanding, a thesis. You know, like, and each property, it's one property in a street, which is in a suburb, which is in a local government area, which is in a state, which is in a country. You know, like how it actually performs, like over the long term, no one actually knows. You know, and like a commercial buyer's agent who's more heavily focused in the commercial realm, they're always going to say buy commercial because that's their sort of like bread and butter. The buyer's agents that have commercial and residential arms, generally you've got that high deposit rate. It's better to go into a commercial property because, you know, holding a large portfolio of properties is a pain in the ass.
That's a good point. Yeah,
like you're kind of at this yes, like it's an inflection point where you can just take the easier route, save your money, and then start building commercial properties because the cash flow is, he said when he asked that question, answer that question, when do you want to, hang out the boots? He said yesterday. It's like, well, that's a straight, you're going for cash flow play.
Yeah, but that was a joke because most people. Yeah, no, seriously, I'm fine with delayed gratification and growing over a decade and not pulling cash out of the portfolio at all. I just make that joke because most people listening is like, I want to retire now, but I'm good with like sticking the course,
Yeah, and like you model it all out, and generally, if you model something out, it's like just sticking to commercial. Once you have those deposit rates, will assist you in getting to that that end route. And like cash flow, as a few of the conversations we've had on this podcast, it's gotten like only the ego cares about your net wealth. It's the cash flow element that essentially gives you that financial freedom. And this is why it layers over your personal, situation because you need to understand where you're at with, what are you doing with, income, your business, or like, what are those sort of 5-10 year plan going through? Like at least 4 years is kind of my thing because you can buy and sell out a property within a 4 year period now if you pick the right markets. And then you sort of take the chips off the table, de-risk it. So it's not like a buy and hold forever situation. But, if you've got 100K, that's not enough to go into really a commercial property, which means that you probably sit on the sidelines for another year or so or two, depending how much money you're saving. And you can go into that commercial. But like for yourself, I still think that like the end goal would be, thinking it through a little bit more deeply and going, well, you don't want to, like, you want to learn from those that have done it before you, basically. And as Jeff, who we had on the pod last week, Steve McKnight, everyone knows Steve McKnight in the property investing space in Australia, like 100 properties, like 0 to 100 properties, and he did it in a few years. Everyone tells you it's a pain in the ass and they consolidate down to 1 or 3 high income commercial properties, and then they just get on with whatever they want to do in their life. So do you want to take that path of scaling residential and playing that essentially a little bit more active role in your portfolio? If so, then what's your income looking like over the next few years? How solid is it going to be? And this is where you go into the personal. It's funny, right? Like, probably shouldn't say it, but anyway, I do say what I want. Like, this is personal advice in a way, isn't it? Like,
yeah.
But you figure, all I do is help people figure out a problem, and then they make the decision.
Yeah, well, I mean, personally, like, I'm okay with like income. Like, I'm good with income and earning income for the next few years. And if anything, I just want to take that income and put it into investments, property and the such. And so it's like I could go either route. I could go like I'm not in a like for the next 10 years. I'm like I don't need to, get cash flow from the properties, because I will work and I'll have some income. So then I'm like, do I just go for the growth? But you're right. Like why? Like let's say I've got a little bit. I've got more than 100K, right? But say I've got 100K cash, and then I've got other properties I could sell, and I could just get like a decent deposit together for $1 to $2 million residential property. I mean, commercial property. Do I just wait, sell down a property here or there, and then put that together and buy a large commercial? Because what's the growth rate of that commercial, and then the income, versus 10. I mean, 10. You're right. Like 10 small, or maybe even 5. Like, say I've got like 500K for a deposit. Like cash, like I could buy 500K properties with that, or I could buy $1-2 million property. Like, what do you do? Because there's a lot of people listening to this that are some high net worth individuals that might have 500K cash. I'm like, where do I go? So what would the opportunity cost be on that, do you think?
Can of worms, mate. Can of worms. I need people listening, reach out and let's have a chat about it. But because everyone's different, like obviously age, got goals and everything. One thing I would say with your situation is you haven't had enough time in the field. Like you're hungry and it's great, and you're making good cash flow in your business, and you want to deploy it in investments, and your future self's going to really thank you for what you're doing here. But I'm not a fan of buying and selling property. Like you've only held the ones for a few years now, and like that's the thing about property. It's boring. Like, and it should be boring. Like, I think that's sort of like, good investing is boring, and it's just sticking to the fundamentals. So, like,
true.
Your portfolio is still like it's really well balanced now with capital growth and cash flow, and even your commercial is still in a metro location, so it's still a capital growth play. And it wasn't like we weren't hitting that sort of 8% net yield play. It was a really strong balance because it suited your buying profile, given your age and your income. So stoked with that. You still got
just
capacity.
Be patient, like everybody tells me, Sam.
No, I want to buy your property because I love it. It probably would be like it would be an interesting exercise for you to maybe do it yourself or coach you through it. It's time consuming, mate, but like maybe like from an entertainment perspective, everyone, it's like a
entertaining for you.
But this is. I'll finish what I was going to say. Is your portfolio is not big enough to actually stop buying residential? So there's definitely the capacity to add another resi in there.
Cool. And why do you say that though? Because this is great to understand why.
Well, from like you've got WA, you've got Queensland residential, and then you've got Queensland commercial. So pretty well balanced. But like generally, I like to see that 3 to 4 residentials, and then looking at that because you're diversifying your income from the residential space. I believe that the residential is lower risk from an income perspective, and then stronger on the growth perspective because you've got the emotional end user that's there. I'm a proponent of obviously both, but I'm more on like during your accumulation phase focusing on residential, and then going into your commercial. Going into commercial early, it was a play that you had that borrowing capacity to go a little bit higher on that commercial, but the better deal that came through resulted in a lower purchase price. But it still was
going to get more capital growth than a larger one anyway. But only slightly.
Yeah, so like it's just that commercial space is really quite limited at the moment, and obviously the costs involved of entering in and the availability of decent stock. You'd be sort of waiting for maybe a few more years to make that trigger. Seeing a sort of like 4 residentials and then a larger scale commercial is always a nice thing to see. for people in your demographic where you only got income. Income's not the driver, capital growth's the driver. So that's sort of that play. I'd be liking to leverage into, but if you wanted to hit more income ASAP, you may as well just pay down current debt on the existing holdings and then go into a larger commercial in maybe 4 years' time. And then you just hold those 4 properties, 2 commercial, 2 residential, and then over another, like at that time, your residentials, you would have held them for probably 6 to 10 years, sell them down, buy a third commercial with the thing, and then you've got 3 commercial assets to diversified, and then you just focus on smashing down debt, and then you're pretty much done. Would be where I'm leaning towards.
Okay,
but
love that plan.
That's where my mind's sort of running, but obviously, there's no right way to skin the cat. It's kind of like I just then reflect back. This is my thought process live, which is interesting to think through. We're good to go back on this later in life.
Deep into Sam's brain.
But where am I at with the current economic environment is a really important factor. I believe that we've been constrained from lending for a number of years now with obviously higher interest rate hikes. We're just seeing a cutting cycle coming through.
Yeah.
There is a bit of pain in the market, and you're looking at from an Australian. This is why you leverage education podcasts and professionals. But this is just something like from a political standpoint. Both, like there's an election this year in Australia, both parties are talking about easing either lending restrictions or getting people more access to first homeowners. There's a big push for people wanting housing and there's not enough supply, and how to help people get in. That is an indicator for growth because they're stimulating that back end. So that's where I sit here and go, look, there is opportunity there. And then I'm looking at your portfolio too, and I'm going, you got Queensland, you got WA. There's some really interesting markets. Like the next pump is not going to be in any of those. I've already talked about it. So
yeah, we have.
It's like Victoria.
All of our other episodes, guys, to find out which one we talk about in it.
Victoria, and then like diversification wise, right? Like you're positioned to either buy next in Victoria or New South Wales or even Tasmania. Northern Territory is kicking at the moment. That's highly volatile. Could be interesting to look at, but once again, that's a higher risk play. So you're going for a bit more of a higher risk in this one from if you go residential. But point being is that it's leaning more towards, in my brain, like a residential play.
Yeah.
Because sitting on the sidelines, if you've got that cash, you're paying down debt, so you're kind of making like 10% return on investment. Like say your interest rate is 6%, you got to pay tax on that hypothetically. And then you're like, well, for property, if you're buying right within a couple of years, this is not like to be held up against, but your cash on cash return sits around 20% based on past performance in your portfolio. And obviously, Goose McGrath, we have the potty. He backed that up in where he's at. So, you're willing to take a little bit higher risk, got higher income. Like I don't see residential as that higher risk. It's just making sure you're buying in the right market, which leads me to the confidence in there. But I'm not a commercial buyer's agent either, so there's full disclaimer.
Yeah, but I mean, I've been through the process of commercial, and I do know it takes longer to get a $2 million, anything under the $2 million range, or $2 million or $3 million compared to like a good $10 million commercial property. And so the opportunity cost is like me having that cash sitting in a bank account that is an offset account against some other properties where I could put that to better use, get a better ROI by getting into the market and waiting another 4 years. Maybe I buy 2 or 3 more properties in the next 2 or 3 more years, 2 to 4 more years, and have those. I mean, what's an extra 5 emails a year or 10 emails a year for maintenance or something, for 3 properties. It's fine. I've got my inbox is a psycho anyway, Sam. You should see.
Yeah.
So,
Well, and you're diversifying pretty well too. So, like, and this is the thing, when you start accumulating assets, if shit hits the proverbial fan, whatever, that's what I'm saying.
Yeah.
But, like, you got assets to sell, and you've got some decent cushions under you because obviously the growth that you've experienced over the last 4 years. So, it's a good position to be in. You're really only in it because of all the risks like you took at those younger ages. This is why I say to people, like, try to get invested early in life. It helps. But
it seems like we've got the answer then. Like, it's like,
well, let's talk it through it. Like, because there is no one answer. And this is where I say everyone's different. You're hungry and you're driven. This was from day one. You were saying you're hungry, you're driven. You want to, like, scale and build, and in order to keep scaling, there's going to be an income issue. But obviously, you've got it pretty well balanced as it is, and that is sort of my thought processes around it. It would be good. Sort of thing. Do we get Steve back on the podcast and ask him, like, because, like, his argument is always going to be like, well, commercial because of the demand that's there, and there is an undersupplied commercial market that does grow as well in value. It would be, and that's why I say, like, you need to track your portfolio to see the performance of it, but you haven't had enough years to actually really get, like, a sound like data set to go, oh, well, that commercial actually did grow the same as residential because of XYZ.
Yeah, it's a really good point. I haven't had that commercial. I've only had that commercial for a few months now, and well, maybe half a year, but yeah. And the same with my other properties. Like, I bought my first one in 2022. It's been 3 years now, and so yeah.
Well, the modeling, if you model it all out in a plan, would say that you're going to get better. Your net wealth is going to be greater through targeting stronger capital growth assets, but your cash flow is going to be a drain, obviously. And there is there's data that backs up. I mean, like, we've had a few prominent buyers agents on this space, and even, like, location research experts as well that like, go through any property sort of forum or whatever you want to do. I mean, there is an inverse correlation between cash flow and capital growth. So, to each their own. Like, I know Selena, she's more about cash flow because that's what you retire on, gives you that freedom. But that's probably more the majority, I would say. Like, this is where you go deeper into your personal life. Like, you don't have kids. You got yourself. You've got a successful business that is making good cash flow. Like, you've got a strong portfolio. So it's kind of like cash flow is not your driving factor.
Yeah.
So that leads me to go, let's get into a resi, and, like, depends on your borrowing capacity, but that's where we go and figure out and talk to a really good mortgage broker, and then we say, look, what do we have to play with? What options are available from a residential space? And then you continue that conversation to sort of iron out, because you, like, say you chose residential, like, based on your situation, you can't do commercial, so that's out. The only thing you can do is resi. I would also say you need to have some cash reserves as well, but I know your personal situation, you do hold
cash reserves for resi.
Just in a portfolio. So, like, like, you've got.
I'm always going to have a business war chest and a property war chest.
Yeah, and you've got liquid assets that you could, sell down if you had to. If you were like, oh shit, like, something broken, I needed that 10 or 20 grand tomorrow. Like, you've got other liquid. Like, this is where I'm not just a property guy. I'm diversification, and that's why I like shares.
Which is why I want to speak to you about it, because we've got these people that come on our pod, and they're so good at, like, the one thing of, like, finding the perfect property to buy, based on where you're at in the portfolio. But we've got all these other things that are so tangible in your personal life. Like you said, do you have kids, or are you single? Like, or just got a spouse, or do you, how long are you working for, want to work for? Like, is cash flow important? How fast do you need cash flow? Can you wait a few years and get capital growth and then start to take the cash flow play? Like, or do you have cash reserves? Like, these things are the things that are unsaid, I guess, in the property investing space that we need to make more common.
Yeah, bring to light. Well, that's why I say, like, shares or crypto is always great because, property is not a liquid asset. Like, until you get to a point where you have a multi-property portfolio being 4 or more, like, yeah, if something happened and you need to get access to cash, you can sell the property. But, the timeline to sell a property, you're looking, like, best case scenario, you're looking at 90 days to actually get, funds, because you got to find the agent, put it on the market, sell it, settle it.
Mm-hmm.
So that, minimum 90 days in that example. That's why it's like, where you go wrong in investing is by having to sell things, because it's the time in the field that counts. So, like,
because you want to sell at the right time, you don't want to sell when you need to sell, which might not be the right time.
Yeah, forced selling sucks. Like, I'm looking at like, from a liquidity perspective at the moment, like, the crypto and the share market have taken a pullback post the US election. Yes. Before that, it was really strong, but you sit there and go, well, like, now, I'd be buying, because it's a pullback.
So I've thought about that. I was like, what, do I just a little bit of crypto in here? But, like, the risk is high with crypto. But, like, even, I mean, if we're talking about 18.6-year cycle, we're like, whoa, okay, like, it's the last little downturn before, like, the winner's curse phase, like.
Yeah, well, this is great.
But then you're investing for a short period. You're investing for a short time frame, which is kind of like, I don't know if that's the best move, because you like, do you invest for a year in, like, crypto or shares? The reason I'm thinking about property is, like, in Australia, we have our own bubble of, like, goodness here. We, like, and if you're investing in property, you're pretty going to be fine if there's a pretty major downturn in the world. Like, your property's going to go back 5%, worst case scenario. Like, does that matter?
But you'll definitely have a tenant in there, and the tenant.
Well, we've got a housing shortage, like, and there's incentives for, like you said, people to buy. Like, of course things can go wrong. Of course, and this is not financial advice, but, like, it's pretty safe bet if you're going to invest money, but in crypto versus shares versus property in Australia. Like,
biased opinion, but I mean, do your own research and figure it out yourself. But I'd sit there and go, shares beat property hands down from a growth perspective. But when you add leverage in, that's where the secret sauce for property.
Yeah.
But, like, what's the sort of lower risk play? I mean, there'd be share people out there be like, well, I wouldn't invest in property because it's not liquid, and I understand the share market, I understand this business. I think we've got, like, Big Mitty from school. He's got he's
Big Mitty.
He's right into he left engineering and now he's gone into, like, because he was doing, like, things with oil. So
he was a mechanical engineer, right? The guy is an actual genius, though.
Yeah, but then he's gone and used his skill sets because he understands oil markets through engineering, through working for those big sort of corporates.
Yeah,
and now he trades it and he does really, really well. But, he's in it every single day. He understands it, so it takes the risk out of it for him. But
and he's a descendant of Einstein. Like, that guy's so smart.
Yeah, we're just simpletons, mate. So, like, go back to your question. If you want to do something now, I think there's an opportune time to do it. And, like, this is where I go from property. Like, lower risk is, for me, it's how I see if the world went, like, and the world was always going to go to, like, a potential ruin, and it always recovers. You look at GFC.com bubble, or we just had a virus go where we locked down the whole world. You had it was like the late 80s, early 90s recession. Before that, there was depressions. Like, and
Yeah,
guess
we've
you just
always
look at the
recovered.
charts, right? So
Yeah.
it's kind of like even if the world ends, it recovers.
Like
And
if I'm going to
Australia,
buy something this year in 2025 and it goes backwards 10% over 2026 and 2027, like it's okay for me. Like I'm going to be okay. Like,
well, that's a really good point actually. Because like say I got a friend who went through a buyer's agent, mutual friend of ours actually. They live in Sydney. But they bought a property through a buyer's agent, really, good buyer's agent. They bought in Geelong, and when they bought,
is this one of
it was
our friends that used to live in Brisbane?
no,
Oh, different
no.
person. Okay.
If they listen to the potty, they'll be like, "You talking about me?" Yes, yes, I am. But I'm not saying your name, so it's all good. And anyway, the fundamentals for Geelong were there, and it was a sound investment. No one saw that, the virus thing was going to hit, and then the government was going to lock down so severely, and then the government was going to introduce, tenant sort of like restriction, or not like landlord sort of implications for increased improvement of tenants, and then they also added in a land tax in Victoria. So it's just like, look, you can't predict that, and this is why diversification is so key. But looking at it now, like I know a lot of buyers agents, and I've been looking at Geelong for the past 6 months, like as a really good growth opportunity. And it's like, well, you bought it with a 10-year time frame, so bloody stick to it. Stop pissing about. It didn't do anything for 3 years. Okay, that wasn't your thesis, but people like yourself, they're like, oh, it hasn't done anything in 2 years. I'm going to sell it. And I'm buying properties, but investors are selling because they're just like, oh, it hasn't done anything in 3 years. And then Queensland's gone bananas, WA, South Australia, what a shit ride. And it's like, right.
It's the last few years has caused people to go cuckoo with their level of expectation from investing. Then you wreck. I see this with online business. People like, I'm going to buy this. I'm going to double the business in 5 years. I'm like, well, or they want to double it in like a year or 2 years. I'm like, do you like that's crazy. Like you may have heard somebody do that, but like, what would it be so bad if you got 10% growth? Like really, like, or what if you didn't get any growth and just stayed the same, but you got cash during that time frame? Like, and you can sell for the same price. Like you're still winning. Like,
yeah. Well, this is my thought process: is that cost of living has gone up. Everything costs more, and I'm guilty of it as well. Like I went to, mate, you wouldn't believe it. I went to the shops. I bought milk and bread, and it cost me like $15 or something like
what?
that. No.
For milk and bread?
Yeah, we buy this A2 milk. It's like $7 or $6.90 because it's like, better for the body. Apparently, my wife tells me. But then it was,
and then $7 for a loaf of bread.
Yeah, something like that.
Good seeded stuff.
Yes, stone baked organic sourdough, whatever.
Perfect.
But like, I know we're probably going, but you still sit there. I'm like, what the fuck? Why are you? That is insane. Like, just the cost of living is insane at the moment. And so, anyway, point being is that people are like, if you're working, especially for wages, like wages aren't going up in relation to asset values or business income.
Right.
So people are trying to like hedge it and go, well, in order for me to keep my current level, and we've talked about this in a previous pod, to keep my current level of living standards, I need to take higher risks.
Yeah.
So they're going in, and then social media confirmation bias, just flip the property for 50% growth in 12 months. I'm a genius. Follow me. Where do I get my income from? Look, probably get it from all my followers and all my deals.
Yeah.
But yeah, sorry, ranting.
Yeah, but I mean, back to resi, it seems like it's the next step is like, I'm not going to buy a commercial in a large commercial in the next sort of 2 to 3 years. So if I've got 100K sitting in an offset account and I've got a bit of cash reserves, if in case things go bad, like obviously the next logical step is to put that 100K to better use. I mean, I know it's decreasing my loan amount on one particular property. But if I can get something that's got okay growth, that can be, a couple of percentage more growth than having that in the offset account. And it also hedges it de-risks my portfolio by being in, Geelong now, or like somewhere in New South Wales. Like,
yeah, well, you've got a few different little aspects, mate. Like, you should be building it. Like, I know you're only 37 now, but chipping away, your super. You can buy property through super as well. Your future self will thank you for that. I'm not a financial planner anymore, but there's some good ones out there. If you want one, obviously reach out. But yeah, like your options in my mind is like it's not commercial now, and nor do you really want to go sort of like another sub 1 mil commercial. I think it's like
I think if
the
I want to
juice
go
comes.
again, we want to go bigger. Yeah.
So it's like residential, or then you go down like a share path, and this is another point where it's like we've talked about this as well on a podcast. So go back to the start and listen to everything, but pick your investment class, because like dropping $100,000 on a share portfolio would probably feel quite daunting because you don't understand it. You've been in this space now for a number of years, and it makes sense. And then with all the information and support around you, like probably more confident in that residential space. But yeah, just factoring in liquidity is really important through drawdowns in your business income. And the more debt you take on, obviously the more repayments you require. So just factoring in your personal budget, you can model it out, your portfolio in 10, 20 years, but it's not 10, 20 years is what you should be looking at. It's like, what's the next 4 years going to look like from a cash flow perspective? Because they're the hardest years to hold it, and then the rest will just be you'll just be cruising.
That's a good point. Yeah, that like those first few years are the hardest years to hold it because it's it's going to be the least profitable, and then also things can change in 2 to 3 years as well. Like,
yeah, you'll be married, maybe in
married,
other
7
side.
kids.
You're married in you could be in a different part of the world, mate, and then you'll be I don't know, it could be, depends on whoever you end up with, but it could be expensive in northern
Norway,
Europe or wherever you end
not
up
moving
in.
to Norway. Not moving to Norway.
Nah, but I mean, if it gets too expensive, you just sell assets, right? But
Yeah.
there's kind of my thoughts. This is where when you go to a financial planner, they're not going to take higher risks because it's not within their financial services license. It's going to be, you go and invest in, for the ASX 200, you might do a leveraged ETF and put your majority in like a pretty S&P 500 type play. So your return on investment would be around that 10, maybe if it's leveraged sort of.
And then you're paying them fees and
like they'll model it all out, but it's just this is why property kind of sucks in Australia, is like it needs to be a cohesive approach within within shares, like a portfolio. So working with, in my opinion, you need a good accountant, a good financial planner, a good buyer's agent, and a good mortgage broker, all in one sort of like cohesive environment where they're just figuring out the plans and giving you that option. Being mindful of you run models based on everyone's sort of conservative on that front, especially with property. It's like everyone runs like a 5 to 6% growth rate, and that's good for being conservative. But there's markets that you can really do well in, but no one really understands. And after being in the industry for a while, I much prefer property over shares, but I love having shares and crypto for a little bit extra exposure and liquidity, especially crypto. Like that's crazy, that stuff. It's interesting. It all could go to hell in a handbasket. Like, imagine if the internet turned off.
The internet cannot turn off. Like that. That's illegal. Like
hell,
that.
Mate. What about a civil war? That's happened in the past.
The first thing that happens in a war is you cut communications. But then you just get a couple of government officials to pay some good money to Elon Musk and get us up and running again. But it's Like if the world needs to cooperate to work together, you need the internet now. It doesn't work without it. So, I mean, we're going deep, but yeah, I mean, this is a good chat. Thank you. Like it's the next step for me now. And I hope everybody else listening is like, okay, it's like, there's so many variables to think about that you mentioned, Sam. So like, do I buy commercial or do I buy resi? When and how? It's like, well, have you thought about all these other situations in your personal life and then outside exposure with crypto, shares? Talked about the property market cycle. We talked about like the Australian property market, like state of where it's at. There's a lot of factors to consider. So appreciate
Yeah,
you.
and this is a really good point. And analysis paralysis. It's kind of like just zoom out, keep it super simple. What do you know? What do you understand? What are you gravitating towards? And take the next step. You know, like doing nothing. And then a month later, like that's where it kind of goes into nothing. Like have that conversation with. I mean, obviously you're in a
person's the next step, like a mortgage broker. Yeah, and just
it's just like
and then get data information, and that data information is going to allow you to say yes or no, and you make a conclusion. You're not just go, I don't know what to do, and sit on the fence the whole way through it.
Yeah, and the final departing point I want to make is like, no one cares about your money more than you do. So do the work. Like, yes, we're all about outsourcing it, but we're outsourcing it through it, like after education, not just outsourcing everything. Like, yes, there's the trust involved with certain people, but Dunning-Kruger effect is really like big in my mind. Where like some people do like a little bit of information, they have confidence, and they think they know everything, but they don't have the runs on the board, and that's pretty prominent in the property industry, and also the share. And like even now, we're talking with PK, like all the crypto or the currency traders that are out there selling your courses, and like just be careful.
Yeah, absolutely. Thanks, Sam. Really appreciate you. Everybody who's listening, thank you for listening. If you guys have questions around like what should you be doing within your property portfolio, let us know. We've got a mutual friend of ours that we might see if we can try and get him on the podcast, because he's might be jumping. He's listened to the pod and he's in a position that he might want to purchase something, and it might be his first purchase. So we might sort of break that down as well. And let us know if you guys do think these EPs are valuable, so we can create more of them.